Welcome back to the second part of Topic 8 lecture. So here we will discuss a case study of Detroit City in Michigan, and we will apply what we've learned in Learning Objective 4, and then we'll move on to Learning Objective 5. So to analyze the key ratios that measure financial performance, we will look at this case followed by the authors of your textbook, The Condition of Detroit, Michigan. Some of you might have heard of this city because it has been infamous for getting bankrupt. So it says here that as your text goes to print, the city of Detroit has emerged from bankruptcy, and in accordance with Michigan Public Act 181 of 2014, it is currently monitored by the Detroit Financial Review Commission for compliance with the Plan of Adjustment. In the 2016 CAFR, Detroit indicates that its debt rating has actually been upgraded from the time the last edition of your textbook was published. At that time, its debt had received a junk bond rating of CAA2 from Moody's. So currently, it has improved its debt rating to B2, A being the top. So this puts the uninsured debt in the below investment grade category. The audit of the 2015 to 2016 financial reports conducted by Plant and Moran provided Detroit with an unmodified opinion. So what does that mean? So it's like the clean bill of health when you get an unmodified opinion from the auditor. As discussed in the MD&A, Detroit is making progress toward a sound financial footing. The bonded debt decreased by $5.8 billion in the fiscal year as a result of eliminated, restructured, and new debt associated with the bankruptcy restructuring. So we are asked to use the information from this table where selected 10-year trend data from Detroit's CAFR are provided. All right. We will not go to the 2016 CAFR. However, in responding to the requirements, we might have to actually refer to some specific disclosures in the CAFR. All right. So the first requirement is to use illustrations 10-3 and 10-4 to determine relevant ratios to construct from the above trend data. All right. So from the ratios you construct and the other trend data in the statistical section of the CAFR, we are asked to evaluate the financial condition of Detroit as of 30th June 2016. And we're asked to provide a brief write-up of the analysis conducted. So, some of the relevant key ratios that we could get from illustration 10-3 that would be relevant for Detroit would be the liquidity, definitely, because they have been bankrupt, and also the revenues over expenditures. And this information, the calculation of these ratios, are actually provided in this data that they have given us. So we don't even have to go to the CAFR. So for liquidity, the formula is simply cash and short-term investments divided by current liabilities, and these are given for each of the 10 years 2007 to 2016. So let's just calculate for 2016. We have the cash and cash equivalent of 595 divided by the current liabilities of 343, so that should give us $1.73 liquidity ratio. So that's for 2016. For 2015, we'll do the same. 652 divided by 384, so that's 1.7. And you can do the same for the rest of the years. What about revenues over expenditures? So we have the total operating revenues over the total operating expenditures. So we can see from here that they have provided us the governmental fund total revenues and the expenditures. So we'll just divide 1,353 by 1,146 for 2016, and the revenues over expenditures is 118.1%. Just multiply it by 100. For 2015, we'll do the same. 1,378 divided by 1,506. So we'll get the revenue over expenditure ratio of 91.5%. All right. So we'll do the same for the rest of the other years. For the debt limit used, it is actually given to us. So we've got the legal debt limit used. Percentages are given: 34.49, 56.86%, and so we can just put that in. All right, so we don't even have to do any calculation for the legal debt limit used. Same is true with the debt service operating expenditures. It's also given 13.53 for 2016 and 18.30% for 2015, and so forth and so on. So once we have already tabulated, so as you can see, the calculation is actually very simple. What is important though is the interpretation, how we use this information, these key ratios, to make an informed judgment or analysis. All right, so in providing a brief write-up, let's have a look at the liquidity first. Liquidity is now over the acceptable benchmark. So remember, the acceptable benchmark for liquidity is at least 1. In both 2015 and 2016, liquidity ratio is above 1, so they are at the acceptable level. But in previous years, from 2014 all the way to 2007, they have not reached the liquidity acceptable benchmark. What about revenues over expenditures? Well, there's still difficulty to ensure that expenditures are covered by revenues. As you can see here, Detroit hit a strong benchmark of 105%. So remember, 105% is kind of the good benchmark. So when did they reach this benchmark? They reached it in the year 2014 as well as 2016. But all other years, 2015, they kind of missed the mark here. All right? So it's only 2014 and 2016 that was fine. In fact, 2013, they reached almost there, 104.5%. They just missed by 0.5%, but still not quite there yet. So the rest are below the strong benchmark. What about the debt? The debt relief from the bankruptcy improved the trend in the debt limit used. As you can see here, their debt limit has always been above 50% for most of the time over the 10 years. But in 2016, it has been below the 50% limit. All right. So there is an improvement there, but whether they can sustain it or not is another thing. What about the debt service percentage? Debt service percentage remains a bit high at over 10%. As you can see, it's actually none of the years that we are analyzing has got less than 10%. But it is not considered unacceptable in the sense that, well, it's really more than 20% that is such a big cause for concern. Other trend data indicates that the general fund balance is the best Detroit has since 2009. If you have a look at the general fund balance, this portion here shows that over 7 out of the 10 years they are in negative. So from 2007 all the way to 2013 they are negative. It's only from 2014 that they have positive 53, 438 in 2015, and the strongest is in 2016 with 501. All right, so the movement in these indicators also indicates that Detroit is improving its financial condition. However, there's one disturbing trend, that is the continued decrease in governmental fund total revenues. So focus on this one here, the governmental fund revenues. All right, as you can see, it was 1,910 in 2007, it decreased in 2008, and guess what? All the way up to 2016, it's still decreasing. So 1,378 in 2015, and then it decreased again in 2016. This would need to be further investigated to determine if this trend can be improved. All right, let's move on to the second requirement. Requirement B says, based on your analysis, do you agree with the auditor's unmodified report? That is, do you see nothing that would indicate a going concern issue? So when there is a problem with going concern, then that means it is likely that the entity is not able to continue its operations, and therefore they are unable to be seen as a going concern. So the question is, do you see nothing that would indicate a going concern problem? All right, so based on the analysis that we've conducted, it would appear that given that Detroit's liquidity is increasing and has improved, particularly in the last 2 years, as well as the revenues over expenditures being healthy in 2016, 118.1 above the 105% good indication, then we can say that Detroit is moving in the right direction. Even its debt limit used, debt service are improving. All right. Because of that, at the current time, there seems to be nothing that would indicate a going concern problem. So that means we expect that the city of Detroit will be able to continue its operation. Therefore, using just the financial analysis conducted, the auditor's opinion is justified. So the unmodified report is justified. Let's move on to requirement letter C. Now, after completing your trend analysis in Part A and providing your opinion in Part B, we are asked to refer to the section entitled Analyzing Government-Wide Financial Statements. And this is found at the end of that section in your textbook. So there are a number of warning indicators concerning fiscal distress that are listed there. And the requirement says use these indicators and discuss whether your opinion in letter B changed. So our opinion in B was that the unmodified report of the auditor is justified. So firstly, let's have a look at some of these warning indicators as shown in your textbook. So in that paragraph, it says, despite the complexity of evaluating government-wide financial condition, there are recognizable signals of fiscal stress. What are these? It includes a decline or inadequate growth in revenue relative to expenses. So let us start with that. We have already highlighted that in the case of Detroit, there is a decline in their revenues relative to the expenses. In fact, the fund balances or the government fund total revenues has continuously declined over the 10 years provided here. All right. However, there's not much of a decline over the past 4 years in terms of the revenues over expenditures. As you can see here, yes, whilst 2016 was strong, it was less than 100% in 2015, but it was good in 2014 and also in 2013. So there are years that the expenditures are actually higher than the revenues, but it's not a warning indicator. How about this number 2? Decline in property values. Now, we can't see this here in the selected 10-year trend data taken from Detroit CAFRs, but if you actually look at the CAFRs of Detroit, you will find that there is a decline in property values. The total assessed valuation of taxable property has declined every year over the 10-year trend. Therefore, this is a warning indicator. This is something that is also long-term because ever since Detroit has suffered from bankruptcy, more and more citizens are moving out of Detroit because, for one thing, they're looking for jobs. There are no jobs in Detroit, and so they move to other places, other cities and all that as they find their employment. And so there's not that many people looking for properties or buying properties, and the law of supply and demand obviously kicks in. If there's no enough demand, then the property values decline, and of course the assessed valuation of taxable property will also decline as a result. So the government really has to make the city of Detroit more attractive for citizens to come back or for other people to move to Detroit. How can they do that? Well, only if they can lure other companies to move to Detroit and to do their business there so that employment rate can actually go up. All right, let's move to number 3. A decline in economic activity such as increasing unemployment, declining retail sales, declining building activity. So obviously there is a decline in economic activity in the city of Detroit, as what I have indicated earlier. So the economic indicators are either stagnant or weak. It will take a long time or quite a while for them to really kick the economy upwards in the right direction. The population declined significantly at the time of the 2010 census. The unemployment rate is trending downward, which is in a sense a good sign, but it remains well above the national average for 2016, which is a poor sign. So although per capita income has been increasing since 2013, this will be found in the CAFRs, it remains below the level prior to 2013. What about for the rest of these warning signals indicated in your textbook, such as the erosion of capital plant, increased level of unfunded pension and other post-employment obligations, inadequate capital expenditures? Well, there's just no adequate information to assess the trends for items 4 to 6. However, a review of Note 9, so this is a note that is provided in the CAFR. So a review of Note 9 related to pensions will indicate that the pension liabilities were a part of the bankruptcy settlement, which would provide relief to Detroit with regards to this indicator. So there's a note here. If this case is given to you as a research piece, so a mini case or research question, it is likely that you are going to get different answers, and it's okay to have different views on whether you think Detroit is still a going concern risk or not. it certainly isn't in a strong financial condition, even up to this stage. It is improving, yes, but it's still not in a strong financial condition. So how the city performs once it has been removed from the watchful Financial Review Commission will be a test of the city's financial strength. And really, the analysis conducted here is really only up to 2016. And there might have already been CAFR available for 2020 or 2019 at least. So we are actually looking at a few more years of financial data that can be added in order for you to make an informed judgment and decision. But this is just an example of how you can use your knowledge in terms of key ratios in analyzing the performance of a government body. And it's good to always look at real world case study. Finally, let's look at learning objective 5. And this is where we will describe how benchmarks can aid financial analysis and identify possible sources of government information that can be helpful when benchmarking. So when interpreting financial ratios, it's important to look at trends as well as benchmark it with another standard. So when we're talking about trends, we're looking at internal monitoring of trends over time within one organization. The most common method of assessing whether the government has performed better or worse than in prior years is really to focus on the trend or the trajectory. Is it an increasing trend? Is it a decreasing trend? Or is it a consistent performance? According to the Government Finance Officers Association, the GFOA, a government's past performance is usually the most relevant context for analyzing current year financial data, and at a minimum, 5 years of data should be compared. In terms of benchmarks, well, benchmark is any target, range, or a red flag that provides an analyst with a basis for comparison in order to draw conclusions about whether the performance indicators suggest a good or a bad news. Appropriate benchmarks for comparisons can be found either outside or inside of the government. So an outside source would be a similar government. So if you are looking at benchmarking, let's say the city of Boston, you will look for another government that is similar to the size, for example, and the population, the size and the population of the city of Boston. If you are looking at benchmarking a county, you will also look at another county of similar size to the one that you are analyzing. An inside benchmark or internal benchmark could be another government department that is similar to the one that you are analyzing the performance of. Now, where do we get this data, financial data for government? Unfortunately, there's no comprehensive benchmark values based on up-to-date financial data that are available for easy-to-use comparisons. There are some available data out there, but it's not ready to use and it's not that easy to use. So for example, there are raw data such as the one that is compiled by the GFOA in its financial indicators database from comprehensive annual financial reports that are submitted to the Certificate of Achievement for Excellence in Financial Reporting program. But these are raw data, and so it must be converted to useful geographic and population strata benchmarks so that you can see whether you are able to compare your county or your city with another government body that is similar to your government entity. There are, however, other sources of information such as the Electronic Municipal Market Access, in short, EMA. So EMA is provided by the Municipal Securities Rulemaking Board, the MSRB. So EMA is an online service that investors and others can access to obtain information about state and local governments that have issued debt. The users can access EMA to learn more about the municipal securities market, to evaluate the features and risks of a specific municipal bond, and monitor a municipal securities investment and a wealth of information about individual securities. I've actually gone to the website, and it shows in the kind of the front page, the home page, the whole map of the United States. And when you click at each of these states, you can go to a particular government that has issued a debt. So there's a whole wealth of information that you can actually mine from this website. So in addition to the official statement which is issued when a new bond or other debt offering is made to the public, there are other types of information provided, including the type of debt, the initial offer price, the interest rate, the size of the debt issue, and the credit rating for the debt. After a government issues debt, it is required to provide continuing disclosures to the market. The comprehensive annual financial report will be one of the sources of this continuing disclosures requirement. So the best way to understand EMA is to access it through its website at http://emma.msrb.org. And when you have time, I'd encourage you to just have a look at this website, because there is really a whole wealth of information that users of the information, interested users of this information, will be able to get the relevant information insofar as the government bonds issues are concerned. Other sources of data will be the bond rating agencies such as the Standard & Poor's, Moody's Investor Services, Fitch Ratings, and KBRA. So credit analysts assess the government's ability to pay interest and principal when they are due. So they examine similar information that internal managers use in evaluating the financial condition of their government body. Now, internal managers obviously have access to all the information generated by the government as far back as data have been retained, whereas credit analysts have access only to what the management provides or what they require from the management. So in this way, internal managers will have an informational advantage over the credit analysts. However, credit analysts with the bond ratings agencies like the Fitch Ratings, Moody's, Standard & Poor's, and this KBRA, which stands for Kroll Bond Rating Agency, these credit analysts from these companies may have an informational advantage too with respect to benchmark information. Why is that? Because they have data from thousands of entities whose bonds are rated or insured. Moreover, these analysts develop extensive multiple-year libraries, including budgets and CAFRs, and they often visit the entity for discussions with management. And a lot of these credit analysts are actually focusing on just a few government bodies, for example. And so they can focus more attention on collecting data that are not just available to the internal managers, but also data from other sources. So in this sense, because they tend to collect, the analysts of investment firms such as the underwriters and brokers tend to collect and process much less information. These analysts rely in part on the agency's ratings to help them properly determine the credit risk of municipal bonds. So these agencies' ratings would be the agencies like Standard & Poor's, Moody's, Fitch Ratings, and KBRA. All right, so that is it for topic 8. Let me just go back to this verse that I have introduced at the beginning of this lecture from the Apostle Peter's writings. In 2 Peter chapter 1, verses 5 to 7 and 9, he says, "But also for this very reason, giving all diligence, add to your faith virtue, to virtue knowledge, to knowledge self-control, to self-control add perseverance, to perseverance godliness, and to godliness brotherly kindness, and to brotherly kindness love. For he who lacks these things is short-sighted, even to blindness, and has forgotten that he was cleansed from his old sins." Whether you are doing so well or not as well as you expected in this unit, remember that this learning is a progressive thing. You are only competing with yourself, not with other students, but with yourself. You want to continuously progress, and you would like to give all the diligence that you can muster in order for you to achieve your goal, adding bit by bit so that you can progress. And make sure that whilst you're doing that, continue to ask God as your partner so that you are able to walk with Him as you progress accordingly. Also, just like what Confucius said, I like this quotation from Confucius. He says, "The expectations of life depend upon diligence." For example, the mechanic that would perfect his work must first sharpen his tools. Are you sharpening your tool? If you would like to be a good accountant, you'll need to sharpen your tools. And that means that we need to be diligent in our studies, in learning and adding to our knowledge, knowledge after knowledge, topic after topic. So my prayer is that you will consistently apply your diligence. Give all your diligence that you can master in anything that you are actually doing whilst we are here on this earth. All right. I'll leave you with that word of wisdom, and I will see you soon in our class. Bye for now.